This is another episode of me documenting the day-to-day process that I am taking to achieve long-term consistency in the financial market. Today's another red day. This is my third day on the top step eval. We are down another 2R or just under 200 bucks. Why? Well, I had the wrong market approach, but I didn't have to be right to make money today. I came to the market bearish. I had a sell idea. I executed on it with confidence. It played out, but my stop management barely got me choked out of the position. But the thing is, I should have been bullish in the first place because everything in the market told me I should be looking for higher prices today. My model told me you should be looking for higher prices today, but I deliberately ignored that. So let's get into it. Today is Thursday, August 28th, 2025, and this is the optimal market approach. So how did I feel? I was not confident in what direction the market should trade in, but eventually I came to the conclusion that everything on the daily time frame tells me I should be bullish. The development of the weekly range tells me I should be bullish. How the market's reacting to that daily gap tells me I should be bullish. Why am I looking to be bearish? Well, it's because it's what I wanted the market to do, and that's why the approach is incorrect. So you can see how pre-market I'm stating this idea feels stupid. Let's see how it goes. Well, that's not very smart, is it? If the idea feels stupid, why are you sticking with it? And this is a mistake I've been consistently repeating. I'll frame an idea, take a step back, look at the market, know that that idea is not what I should be doing for the day, but I submit to it anyways, and I just play with it. And then what happens? Well, I have a red day. Here we go, right? What's the draw on liquidity? I'm looking for a deep discount of the overnight range or Wednesday daily low because with my bearish market approach, I knew that it was likely to be incorrect, so I was not looking for a previous day low or anything like that. I was simply looking for equilibrium of the overnight range, which it did deliver. Now, Wednesday daily low would be the objective beyond that, but I'm not thinking it's really going to get down there because I'm lacking confidence in this bearish bias. If I'm lacking confidence in the bearish bias, why not be bullish? Doesn't make sense. I deliberately ignored my model or the process that I follow to arrive at a market approach. So what was my bias? Well, I wasn't seeing many reasons for price to trade beyond Wednesday daily high, and the condition appears to be falling into consolidation with a lot of overlap in price runs. So this higher time frame narrative was basically based off of what I thought the market should do today, not based on concrete evidence from the candlesticks telling me this is what it should do today. So it's just purely based on speculation, not what's actually there in the chart. So I wasn't doing what the market was telling me to do. The market criteria that I thought was going to play out today was high day reversal, which it did reverse at the high day and offered over 80 handles on that sell setup, but I wasn't able to capitalize on it. So I was going to get to the draw on liquidity. The draw on liquidity, in this case, I was looking for a discount of the overnight range. I like to see the market rally up and take Wednesday daily high and then see it come back inside the range, which is the first thing that it did at 9:30. If you traded today, you saw that. And I sold it short with confidence. So what setup am I looking for and why? I'm looking for this bearish premium gap opening setup. So for just for some context, my model is basically based on four things because we're either going to gap up or we're going to gap down. So we're either going to gap up and the market's going to continue in that direction, or we're going to gap up and it's going to reverse, or we're going to gap down and the market's going to continue in that direction, or we're going to gap down and the market's going to reverse. That's it, right? So my bearish premium gap opening setup is a gap up and the market continues in that direction. If we run through these real quick, you can see that the market criteria is very similar to what showed up today. First, let's look at what happened today. Today is what? Is today the 28th? I thought I just said it was the 27th. Today is the 28th. So note how we have a gap up. Here's previous day settlement. 9:30 gapped up from where we settled yesterday. But note how it leaves something in the overnight session for the market to grab onto. We have this impulse swing in the overnight session. The market opens, trades up into Wednesday daily high, then trades down, takes pre-market sell side, rebalances the overnight impulse swing, trades into this gap, and then trades higher. This is perfect. It's my perfect criteria for my bullish premium gap opening setup. And then here we see something kind of a similar price action, right? Impulse swing in the overnight session, rebalances the range. Now in this case it did it pre-market, so at 9:30 it went right at 9:30. This is today on the 25th of 2022, kind of the same thing. Impulse swing in the overnight session, rebalances that range, takes the pre-market sell side, leaves the premium gap opening open, then trades higher for the rest of the day. So it's kind of similar characteristics that repeat in price, and this is the basis for my model. This is very similar to exactly what happened today. Impulse swing in the overnight session, leaves an obvious gap for the market to grab onto, trades down into it, and then trades higher. Now what I thought was going to happen was my bearish premium gap opening setup right here. And I thought it was looking something more like this. Market criteria, high day reversal, right? This is what I was looking for. But if you notice the difference, the liquidity in the overnight session is low resistance. It's low resistance, meaning there's nothing solid in here for the market to grab onto and trade higher. There's nothing that I should trade down to, drop into, find support in, and then trade higher. If you compare this to what we saw today, right? This is what I was looking for. I was looking for a reversal. But it's also within the wrong context, because there was no reason for the market to actually want to go lower today. There's nothing solid in here for the market to grab onto, and that's why it runs over all that. But in today's session, there was. So let's go to the chart now. So we see we have the impulse swing in the overnight session. Let's start on the weekly. So first of all, let's pull up the annotations actually. Okay. Read this. This doesn't make any sense. I know that I should be bullish. You can tell that by my annotations. Any reasons for me to think the market should go lower today? Not really. It should probably close bullish. Okay, then be bullish. So with Wednesday's close, I'm anticipating consolidation inside this gap. The run overnight, price has been consolidating inside this gap. Okay, it's not true. It's not what's going on. So one of the reasons I was looking to be bearish though was because I noticed how this candle drove above Friday's high and closed back inside the range. So I thought a drive above this high would fail as well. And it did momentarily, but it didn't last. The move lower didn't last. But this candle actually closed indecisive. You see how it didn't settle near its low, right? It closed kind of in the middle of that range. That tells me the market's comfortable where it's at, meaning it's not going lower. You can see the same information on the 1 hour. Here's that large obvious gap on the 1 hour and the 15 minute and the 5 minute and the 1 minute. So it's congruent across multiple time frames. So the market opened, traded up, then traded down and reversed. So I'm annotating this as low resistance sell side on the 15 minute. Go back to the 15 minute. It's not low resistance sell side, okay? Because there's something in here for the market to grab onto. We have this obvious open gap and this obvious open gap. Now this is low resistance. These lows are stacked. They're in close proximity to each other. It can take this out easily. But below that, what do we have? Boom, this obvious gap. So on the weekly, based on my model, if the previous weekly candle settles with a large discount wick, then the following is likely to be bearish. Down to the daily. If Wednesday closed indecisive and rebounds Tuesday's range, then Thursday is likely to settle on its high. If Tuesday traded down, took Monday's low, traded into the daily gap, and settled on its high, then the low of week is likely in. So if all this information, is there anything here telling me the market should go lower? Absolutely not. So what happens as a result? Trades near its high. You note how Tuesday traded into the gap, but it closed above it. Wednesday did the same thing, but this time it didn't even trade to the middle of it. It just barely tapped the high of it and then settled indecisive, meaning, hey, I'm comfortable where I'm at. I don't want to go lower. I'm going higher, especially with this information right here. So it's the same thing on the daily time frame that's going to be shown on the 1 minute time frame. If I see this kind of price action on the 1 minute time frame, that tells me the market's going to be bullish. But in this case, I'm ignoring that. Why? Because I wanted the market to go lower. That's the thing. So 4 hour, 1 hour. Now I can anticipate a drive below this candle's low to fail because it dropped into the hourly gap right there, but it closed above it. That's a sign of strength. Now how the market was opening at the high of day typically leads to that reversal setup that I showed you in Notion, my bearish premium gap opening setup, because the first thing it'll do is open, rally up, take a buy side objective. In this case it did, Wednesday daily high. I don't know why that level is deleted. Let me put it back on. There we go. And then reverse, and then clear all the way towards the Asia sell side, right? But it doesn't do that in this case because we have this obvious gap from the overnight session that the market can grab onto, find support, and climb higher. We have the higher time frame narrative from the daily and the weekly with that discount wick, the daily with how prices react to the gap and the development of the weekly range. Everything points to this should go higher. We're not going lower today. So if I'm bullish on the day and it opens and it trades up first, I have to wait for it to drop down and take sell side second. Then it's going to make the real move of the day. And that's it. So buy side first, sell side second, real move. Now my executions, let's go to top step X. So now you can see the balance on the account right now, 49,780.92 cents. Let's put the executions on. Show executions. There we go. Okay. Now, my first trade was good. I'll pull up the recording, actually. Look at all this data that I'm collecting, so I know exactly where I'm going wrong. And because I collect all this data, I was actually able to go back and study today all the trades that I've taken throughout the entire month. I'm tagging them, and now I'm generating some data that's going to tell me, you know, where I'm going wrong. So I'm noting the first thing the market does, it rallies up. Note how it leaves this level intact. I had one shallow run below it, one tick. Not really confident that that's going to be a solid low. If it was going to be a solid stop hunt, a valid stop hunt, it would dive below that and then violently come back inside the range. In this case, we just went one tick below it. So I'm seeing this level. It's incredibly smooth in price. The market rallies right up into the level that I'm looking for it to reverse at in my pre-market plan. Right? So I'd like to see the market rally up and take Wednesday daily high, then see it come back inside the range. That's clearly what I'm looking for. It does that right at the open. So at this point, I thought the market was just going to be super strong and super bullish because I had the idea on the back of my mind that, you know, this could be an up-close candle day, and my bearish bias is probably going to be incorrect. So I'm thinking, you know what, this is probably just going to go to the fucking moon and it's just going to be gone. But I thought, stay patient. Wait. What was that? Did y'all hear that? I don't know what that was. Anyways, stay patient, wait, and see if the market can confirm my trade idea. So I'm looking at this down candle. I'm noting the change in the state delivery on the 1 minute time frame. Okay, now I'm in top step X. I'm framing the risk on the trade, and this is looking good. I'm using my max risk tolerance of 16 points, and this is where I went wrong in the trade. Because today is GDP, so the day is extremely volatile. The first 1 minute candle was 50 points. So there's a lot of volatility today. There's going to be a lot more volatility. I have to use a wider stop and probably size down on my contract size. In this case, I wasn't aware of that. I used my max risk tolerance of 16 points, which is good in normal conditions, but today we have GDP, we have unemployment claims, both high impact drivers. There's an injection of volatility. The market's moving fast today. So just simply using a max risk tolerance of 16 points is not really going to work. And that was the problem with this trade. I got stopped out premature. But you can still see that my stop basically coincides with the high of this fair value gap, right? Which is where the stop should go anyways. And it's also above the mean threshold of this up close candle. This just happened to be a trade where I got knocked out early, and then it delivered. So boom, I get tagged in on the following candle. I'm confident in my sell idea. I almost get stopped out on that candle. So I'm just sitting in this trade, just seeing, okay, is it going to work? Is it not going to work? Either way, who cares? If I lose, I learn. If I win, put some money in the account, get up on the eval. That's it. In this case, I've just barely stopped out. Okay. Got knocked out there. And so I created a new rule to put space between my losses. Go to Miro. Loading. Okay. So I must put space between losses of 5 minutes minimum. So in this case, this rule backfired because I could have gone back in there at the market and executed on this idea again for the second time. But I immediately start reflecting on the trade after I lost because I'm not going to go back in there immediately and take two back-to-back losing trades twice fast when I'm not confident in my bearish bias and I have a feeling that this thing is probably just going to rip higher and just keep going. So I didn't do anything wrong there either. Sure, I could have went back in, but I was following my rules. So this up candle ends up getting overlapped in the 1 minute. And it offers opportunity to get on side right there, right? That up candle ended up getting overlapped. That could have been a second sell, another attempt. But it just barely went up above that high and knocked me out. So the heat on this trade was 22.25 handles. And before this, the most amount of drawdown that I've had on a winning trade before it plays out in my favor was 19 handles. This is well above that. So this is just one of those exceptions to that. It's going to happen. There's going to be trades where your stop isn't efficiently placed. It's going to come back and knock you out before it delivers. And then, of course, boom, right to the target, right? You saw where my target was. Go back to the recording. Here it is. So I was targeting those smooth lows that you saw me annotate when the market went like this first, and then beyond that, the pre-market low right here. At 7:15, both objectives delivered. So I just barely got stopped out, So I'm not really doing anything wrong. Am I? Not really. I'm following my risk parameters. I'm following my rules. I just barely got knocked out. I'm still able to read the market. Though I was wrong about the direction of the daily candle, did I need to be right about it to make money today? Absolutely not. And that's the point that I'm trying to emphasize with myself, because I stress that a lot. I put a lot of emphasis on having to be right about the direction of the daily candle, but that does lead to all my good trading days. So I do have to put emphasis on that, because for the most part, that's going to make a good session and a bad session. If I'm indecisive about it today, usually it usually leads to a bad session. If I have no idea what the market's going to reach for, it usually leads to a bad session. If I come to the market and I have conviction in one idea and that's it, those are my best sessions. But I just barely get stopped out, and then boom, delivers right to that pre-market low. Now what happened in the second losing trade? Might be wondering. Now in the second loss, you can see that I'm journaling right there. I'm just reflecting on the losing trade. Let's go back to TradeZilla. I got so many tabs open, it's hard for me to navigate. Okay, it's right there. So to me, it was worth the risk when I see a pattern in price that I've seen so many times before, and it's alignment with what I'm looking for on the day. The problem could be I'm just incorrect about the direction of the daily candle. What I don't want to do is wreck myself on the idea twice and fast. That was early and I know it. There was not 5-minute confirmation. So kind of blaming on myself, kind of being rough with myself that trade was early. There was no confirmation in the 5-minute. There didn't have to be. I saw valid confirmation in the 1-minute. Changing the state of delivery, it was obvious. I'm looking for sells only. Above Wednesday daily high, I'm taking it. The risk is worth it. I'm going to take it. It's the whole reason why I took the trade, because I framed the risk on it, and I'm thinking the risk is well worth it. I'm going to take this trade. So then I'm just telling myself, let it be obvious. Sit back and relax. Let it be obvious. But also be attentive to details that prove me wrong. And then I barely stopped out of that. Now at this point at 9:55, I barely stopped out of that one. Now to stay patient and see if I can find a means of getting onside. Might have to expose myself to more risk on the day with the high impact driver and more volatility. So after the first losing trade, I'm still thinking that the market could break lower, and my bias is potentially correct. I just barely got knocked out. So at that point in time, I'm looking for a way to get onside with the move. So what I do is, see if we can see it on the recording, is I frame the dealing range, right? I note the obvious 1-minute gap that's in a premium. Then I'm noting the 5-minute gap, right? I annotate that. There you go. And then I note how the market rejects, trades right up to the midpoint of that 5-minute gap, and then on the 1-minute, overlaps that down candle, boom, and then I sold short at the market. Now this is not a trade that I'm proud of at all. I feel like this was very impulsive, and this is not the way for me to get onside with moves. I feel like the best way for me to get onside with moves is just note a premium array that I have confidence that the market should reject and just set a limit order out there. Don't wait for the market to trade into that premium array and then wait for the 1-minute to reject it and then impulsively jump in at the market. That leads to all kinds of bad trades when I'm trying to get onside with the move. In fact, I caught a huge swing of over 100 handles just getting onside with the move by just leaving a limit order out there, having confidence that, hey, if we're going lower, the market should reject this. It came back up, got me filled, and rejected it. What do you know? This kind of way of getting onside is not valid, where I'm not 100% sure that the market is going to reject that 5-minute gap, so I'm letting it trade up into it and then seeing if it does reject it with confirmation from the 1-minute. Now, I did this a lot before in the past, and now that I think about it, thinking about it as I'm talking about it right now, this led to so many losing trades, where I wouldn't be confident in taking that PD array. I would let the market react to that PD array and then get an entry, instead of just using the PD array in the first place. So that leads to a trade like this, where the risk is skewed because now I'm jumping in at the market. Now I'm impulsively jumping in as the market's reacting to that PD array, and I'm like, oh shit, it's reacting to it, right? Now I'm going in at the market. Because I'm going in at the market, I'm always going to get an unfavorable fill, and the risk is always going to be skewed on the position. Another great lesson from today, the risk is always going to be skewed if you go in at the market. So now I'm completely eliminating the possibility for me to go in at the market, because I reviewed all my losing trades from this month, and every single time that I went in at the market, it was an impulsive, low probability trade. It was a shit trade. So I'm eliminating that. All 5 times I've gone in at the market I'll show you. Tags, entry. Nope, not that. It was order type. There we go. Is there a filter on this? Swear it was 5 earlier. Not sure what's going on here. Should not only be. Oh, okay, that's why. It was only my top step X. Okay. Rebuild, June 2025. Order type. Look how I'm performing on trades that I go in at the market. Look how I perform when I go in at the limit. Look how I perform when I go in at the market. I have one setup where I went in at the market and it should have delivered, but I botched the exit on the trade. Only one out of how many? 9. So there you have it. And in this case, the better entry was just to set my limit order at the PD array that I had confidence the market should reject and just do that. So the same thing holds up. The same thing that I just explained, it holds logic. It makes sense. So that's an adjustment I need to make. So on the second trade, I'm just thinking, you know, I need to find a way to get on side with this. But my market approach is incorrect for the day. So the reason for the losing trade on the second trade is because I was just incorrect about the daily buys. Now, had I got the bullish buys correct today, as my model was telling me to do, then this is a pretty easy change in the state delivery on the 1 minute time frame. Right there. Just take that. So, one thing that I'm noting after today. One thing that I'm taking away from today is my executions are quite random. I use order blocks a lot. Let's go back to TradeZeller real quick. Look at these stats, right? So let's look at all the times that I've entered off of an order block. Look at my performance when I'm entering it off an order block. Look at my performance when I'm entering off of nothing. And every time that I've entered off of nothing, it's been a market order. So all the times that I've executed an order block, 8 times this month, look at my performance. I have a 12% win rate executing on order blocks. That says something, right? So going through these trades, I found that I'm not even executing on order blocks. The problem with me executing on order blocks is it's just, if I'm bullish, then buy a down candle. Or if I'm bearish, sell an up candle. But not every up candle is an order block. And not every down candle is an order block. And that's the problem. And I think it is. So I need to go back and study, reflect on my notes of what actually makes a high probability order block. And then trade that. Another thing is I should just I'm thinking about just getting comfortable with order blocks and fair value gaps. That's it. Not trying to do anything special. Not trying to do anything else. Executing at the limit on those. Just getting really good with those. Because I've kind of created this kind of entry mechanism that I call it. And it's kind of like my own thing. My own way of getting into a trade. But that's kind of backfiring on me as well. Because you can see right here. There's been 5 trades this month where I executed on literally nothing. Why is that? There's been 8 times where I executed on an order block. And only one of those produced a winning trade. Now 2 of these, so 3 out of 8 times I've executed on the order block this month, it produced a winning setup like today. 2 of those 3 times I got choked on the stop. So I have to go back and study, why am I getting choked on my stop when I'm using order blocks? And look at this. 6 trades, I literally have no PD array to frame my stop loss off of. You know, I performed like shit this month. Like absolute dog shit. Tomorrow is the last trading day of the month. But I performed like fucking shit. Right? Which means there's so many lessons in this data. And that's what I see it as. Profitable last month and the month before that, only slightly, but still up. this month, we're in the gutter. Now, this month has actually been brutal, too. I mean, it's been difficult. The conditions is tough. Every day at 9:30, it's doing some bullshit. But if this is hard, then how am I going to trade in a condition that's better and more favorable, right? So, covered about everything today from today's session. Let me know how you did today. I'm curious. Drop a comment section. I answer all the comments, if you haven't realized by now. I literally reply to every single comment. Those of you that support me, hate comments, advice, I don't care what it is, I'm going to reply to it. So if you're subscribed to the channel, I appreciate your support, and that's going to be it for this one. I'll talk to you tomorrow.